Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Shad and Corey here, your hosts for this weekend edition. This weekend show, we're going to be focusing on the commodities sector, as commodities still seem to be in the spotlight with very positive moves, especially in the precious metals, but even copper moving higher. Energy has been a bit of a mixed bag, but boy, oh boy, the celebration I think needs to be had for a lot of us holding the precious metal stocks, even the whole way down to the smaller ones, because they are really starting to move, and now the small ones have been moving for about a month's time. Just as a quick note, please, everyone, go back through our website, podcast, and YouTube channel. Just search the KE Report, especially in your podcast player and on YouTube. Subscribe, leave a review, and share with all your friends, as well as check out all our daily editorials and company updates, because there's a lot of them right now. There are a lot of companies doing a lot of work out there and raising a lot of money. We're starting off this show with Brien Lundin, editor of the Gold Newsletter, also our host at the New Orleans Investment Conference this year, November 2nd to 5th. Brien, well, we're going to focus on the precious metals here because gold continues to do well, but even now, silver is outperforming gold. The gold and silver stocks are doing very well across the board, and even some of the smaller companies, the smaller gold and silver stocks, those have really caught a bid, and they're raising a lot of money. A lot of them are cashed up right now to a degree that I don't even think they were expecting 6 months ago. So, Brien, broadly, what is catching your eye the most in this clear bull market for precious metals?
Yeah, I totally agree with you. I think the key thing right now is that the juniors are moving, as you say. A number of people on the social media and on X have been posting charts lately, and it really is a little bit more of a mixed bag than they're presenting, but we've seen that progression that we wanted to see. We had gold moving for the longest time, 14 months or so. We haven't seen the gold stocks or silver respond to that big move in gold. And for the unique reason in the history of gold, in that this gold bull market was spawned and supported by central bank buying, and central banks don't buy mining stocks, they don't buy silver. So they lagged, and they typically leverage a move in gold, sometimes even lead it, but this time they have been lagging it frustratingly. Now we started to see actually in the first quarter, gold stocks leverage gold. And now we've seen it go down the food chain to where the juniors are starting to outperform the majors in the gold stocks. We're also seeing the silver juniors outperform the larger silver producers, and those silver producers also leveraging silver. And now, of course, literally as we speak, we see a big breakout in silver, and silver finally move above that key resistance level, that level that has stymied us so often of $35. And as we speak, they're doing their best to quash that move, but we're still well above $35. And that's a tremendous breakout.
Yeah, Brien, we've been waiting to see this for a while. The action in the juniors, silver starting to leverage the moves in gold, the silver stocks leveraging the move in silver. So everything is lining up the way you want to see it in a bull market. But it begs the question of, how do you think this will play out in a timing perspective? Because it took so long for those stocks to respond, and we can say that there were stocks responding on the way up. Over the last year and a half, there have been gold producers, best in class, that were moving. Royalty companies were moving. But now that the larger swath of companies is starting to get a bid, are we at the later stage of this? Could this keep running for a while? Is there a danger of it petering out? How are you looking at the longevity of the move?
Well, the timing is always the tough part, and not just when is it going to happen, but for how long will it happen or keep moving. And I think we have to look at both the fundamental and the technical stories for that. Fundamentally, the primary drivers being de-dollarization, being an oncoming debt crisis, not just in the U.S., but in sovereign nations around the world. That story hasn't changed. And that story, I believe, won't change until there's a fundamental monetary reset that will eventually involve gold. So I think we've got lots of time on that move. And supporting that move will continue to be central bank buying. And now I think investor buying, Western investor buying in the associated investments, the leverage sectors of mining stocks and silver. From a technical standpoint, this move is still early. Roughly speaking, from the lows of 2018 or so, we've about doubled on the silver price. I'm not sure what we are over the last year, but I think it's about 40% on the silver price. In previous bull market runs in silver, and I count 3 previous bull markets, early 70s, late 70s, and the 2000s, the gold price went up 5.6 to 8.2 times, somewhere in that range. So we have a long way to go in this bull market to duplicate that kind of performance. And I do think this is that kind of a secular, long-term, monetarily based bull market. So we're looking at it somewhere between 6,000, 6,500 to 8,000 or more on the gold price. The question then, again, is, you noted, is timing. How long will it take to get there? I hope it's like the 2000s and takes a decade or so to get there, because that means we're going to make an awful lot of money in these junior mining stocks. So here's hoping for a slower but steady rise continuing in gold and silver and the mining stocks. And I hope we're going to see that, but it's very encouraging, again, to see silver finally breaking out.
Oh, and I think everyone's encouraged to see their stocks going higher. Our friend Jordan Royburn over the Daily Gold recently sent out some of his breadth data, and he pointed out that HUI stocks above the 20-day and 50-day moving averages is 100%. The percentage of GDXJ stocks above those moving averages is 96% for both of those. So anyone that bought stock in the last couple months, they're up, but I really think anyone who's bought in the last year is probably doing quite well right now. But Brien, as you were saying, we still need gold to keep moving. I think we still need the majors to keep moving, because what I'm worried about, at least in the near term, and it no way signifies a peak in the market, is that the juniors, some pretty crappy ones, if you ask me, they're running and they're raising a fair bit of money. It's more so that, yes, we're getting this money trickle down from, I think, people that made money in those majors and even the mid tiers that have done really well. But if the juniors play too much catch up, to me, that's a problem, because we're not seeing more money come into the sector. So what are you looking at in terms of the top quality companies? We have less majors around than we did 10, 20 years ago. They're not necessarily spending a lot of money, especially in gold. They seem to be buying copper companies. What do you want to see on the higher level, the better quality companies out there?
Yeah, I think they need to just continue de-risking their projects and making themselves the natural other bidder on their projects, i.e. advancing them toward production. And not just a bluff, but seriously advancing those projects toward production, because the majors have yet to show that they're going to go on buying sprees like they've done in past bull market runs. They seem to believe that discipline is going to stick this time. I have my doubts about that, but for right now, they are not going on these buying sprees. They're not getting involved in bidding wars. And a junior that has a great prospect and has been developing it can just simply proceed toward production. And that makes it a more attractive target eventually, because it's de-risking the project, but it also assures a better price because they could just bring it to production themselves. And a number of them will be able to do that, because one interesting aspect of this market, and one that I think that's going to develop further, is that money will find its way. There's so much money just sloshing around the world's markets trying to find a home. And as the themes shift from financial and tech toward commodities, you're going to see billions of dollars dedicated to this sector, really big money. And companies, juniors that have large scale projects will be able to raise the money to develop them. The cost of these projects in our minds may seem really high, but for hedge funds and the like out there, it's a rounding error. And when they get involved in the sector, they, I think, are going to be a big source of the large and stupid money coming into the sector. And, God help them. I hope they do it. And we want to sell all of our projects in our portfolios to big, stupid money at big, stupid prices.
That's a great point, Brian. And yeah, it's a good problem to have. We want to hand them the bag when the time is right. But you bring up an interesting point, and let's tug on that thread as far as the path forward for development stage companies. I know that's in your wheelhouse as far as some of these companies that have a lot of banked success. They have ounces delineated, they have economic studies. They have three paths forward. They can build it themselves, they can bring in a JV partner, or they can sell the project. Traditionally, people like the exit strategy of a takeover, but reality is not all these stocks are going to get taken over. So do you want to see some of these junior explorer developer teams take on the big task of staffing up and bringing in the right team to build a project? Or would you rather see them JV the project? What's your preference?
Well, JV means that you don't dilute. I think it's you have to look at it on an individual basis. If a junior is well valued and therefore its cost of capital on an equity basis is fairly low or relatively low, then they can raise the money and advance the projects. We have tended toward favoring JV projects for many years because the share prices of these companies were in the dumps and it was just too expensive for them to raise the capital to advance a project, too dilutive. And on a debt basis, it didn't make any sense. The money was not there. The metals prices weren't there. Now the metals prices are there. The money is starting to flow into the sector from generalists. So the ability and the favorability of developing a project your own simply on a debt basis can work. And I think that it depends on the project. It depends on the company. You can't look at it on a generic basis, but the option to develop a project is there. And, there's the old adage in the sector that juniors explore and mine builders build mines and they don't cross over. But that expertise can be bought. And companies are realizing that they can do that. And you see that happening even at an exploration stage. Some companies are building it or bringing in talent on a mine building basis to position the project for development and de-risk it to attract the majors' attention, but also give them that option of developing it themselves.
Hey, the majors I get and these mine builders I get wanting to go ahead and build some of these mines. Some of the generalists, though, mines take a long time to build. There's a lot that can happen over a 2, 3, even 4-year period. We'll see if we get that money flowing in. But to your point about these junior companies, Brian, what about all these small companies right now that they might have a resource or a small resource? Let's say an early stage resource, maybe even a PEA on it. And they're talking about starting to mine it on a small scale because they're saying, look at how much money we can make. We can fund our exploration if we can bring this thing into some sort of mining scenario, whether they're toll milling it or whether they're planning on just digging out the easy stuff that is on their ground that they know of. But again, still early stage. What's your thought on these companies?
Well, my advice has been for ages, don't do that because it rarely works. But, we've never had $3,400 gold prices before. We've never had 60, 70% mining margins before for these smaller projects. So it is tempting and it can be done. And I think that landscape has changed dramatically. We're seeing companies like Heliostar who got in right at the wire and found some producing assets that it was able to acquire for a song, rehabilitate them, and then use that cash flow to fund the development of Ana Paula. We're seeing more and more companies with that argument. You look at Western Exploration, essentially two great projects in Nevada, one a bit early stage to be going toward a PEA and a pre-feasibility, but they're going that route because they look at that project that's a bit more advanced to provide the cash flow to explore and develop their second project on a much less dilutive basis. It's a strategy that I think is kind of coming into its own at these prices well above $3,000 gold.
Well, Brien, I think that it's very tempting for some of these companies to try to get into early scale production, even bulk samples where they get paid on it. I've seen 4 or 5 companies. We had to create a hashtag bulk sample just because there were so many companies discussing it, or like Corey mentioned, doing toll milling to get some early production. Can't blame them for doing that to get a little money in the door in a non-dilutive fashion versus an equity raise. But when you look at the silver stocks, they're not really in the same boat that the gold stocks are. Silver is good at 35, but it would be great at 40 plus. Do you think we'll see more of the same kind of pattern in the silver stocks if silver does finally break into the 40s? Because that would make those projects also attractive to high grade and get into production.
Yeah, it would. But silver is a different game, as for projects like the classic high-grade vein-hosted Mexican projects where typically locals have been mining, not drilling off years of resources ahead of them, but maybe weeks, or even not drilling off resources and just following a vein for literally centuries. Those kinds of projects really sing economically when you get to silver prices, as you say, that would get above $40. So you're going to see more and more of that. Probably, I've seen it before, and you can just predict that there's going to be a Mexican small-scale silver mining roll-up play emerging very soon. And that might be a great play. It just depends on the management who's involved and what their experience is. But that's one area where I think, yeah, that model, that paradigm could work very well.
Now, Brien, as well as everything's going right now, I do want to look on the downside here in terms of protection for this sector. Corrections are natural even in a bull market. Gold has really not corrected all that much. It's kind of consolidated a lot of these gains. Silver is also hanging easily in the 30s and now looks to be breaking out. But in your eyes, what's a lower gold price that you think the sector is still safe?
Oh, I think the $3,000 is, one of the things that's happened is this bull market has evolved over the past few months and this year is not that gold touched $3,500, but that the market players, the participants, from the miners to the speculators, have now become comfortable that gold will stay above $3,000 an ounce. Even in this last correction, you had only the most dire predictions were that gold would drop below $3,000 and not much below that. And most of the predictions were around 3,100 on the downside. Once again, gold proved them wrong by not falling as much in the correction as it would have typically or would have done typically in a normal bull market. So I think there's been an awareness that $3,000 are pretty safe above that, and we're content. We're not watching the price on a daily basis, and the price drops $80, $60, something like that. We're not bent out of shape. It's not that much on a percentage basis, but there's also a feeling that we're going to pop right back up, which we did Monday. This breakout in silver is coming, and we kind of forget the fact already that it's coming after a big breakout in gold on Monday. So, yeah, we kind of have to pinch ourselves and knock on wood. It's looking really bright for gold bugs and silver bugs and mining stock bugs right now. In fact, it would be difficult to imagine that it could look much better unless the Fed suddenly comes out with some some rate cuts. And of course, that might happen as well.
Well, Brien, in light of the environment we're in, where we're clearly in a bull market, the pullbacks in a bull market are more shallow than people are expecting. They don't last as long as people are expecting. Is it possible that the sector has got a little bit of post-traumatic stress disorder here, where we're so used to the rug being pulled out and we're so used to rallies being sold and good news being sold and it being a liquidity event, that we're just not prepared for a bull market playbook where people that are waiting for the proverbial pullback may not get it and they may be stuck chasing. Even companies that are waiting to buy companies and do M&A at a lower price may not see those prices and they may have to chase some of these stocks higher. Is the danger here people being out of position or being in cash and thinking, I'll just wait for the next pullback, only to see it not come and to see these stocks run away from them?
Yeah, that is a danger. And, we're starting to see the FOMO hit, the fear of missing out hit, which is famously rampant at these times in the junior mining stock market. We don't want to see our friends get rich without us. But yeah, the danger here, the risk is not being positioned and not being involved. The risk is being too smart by half and in trading in and out of these stocks and missing really big breakouts. I mean, if you look historically, if you look back in the 2000s and look at where average junior mining plays were trading on a share price basis or market cap basis and compare them to where similar stocks are trading today, we're still extraordinarily undervalued, and we have yet to see euphoria hit the sector. We have yet to see prices get crazy in the sector. They have had exceptional moves. I'm looking at my gold newsletter portfolio right now, and our gains are measured typically in the hundreds of percent here. Some quite extraordinary just this year. But still, compared to where they have been in past cycles, they're a fraction of where they would be. You still have companies with big gold projects, millions of ounces, selling for around $10 an ounce in the ground, where in past markets, those projects were eagerly snapped up by big miners at $150, $200 an ounce in the ground or more. So, yeah, it's still early. It really is.
Yeah, you do also have some stocks trading at $50+ an ounce in the ground, and we have seen some acquisitions come at over $100 an ounce in the ground too. So again, this has been a market where the good companies, I think, have really moved first, and now the money's trickling down into the smaller companies. I do still, as I said, want these good companies to keep on running, and I think that separation is good because it shows that even more money's coming into the sector, and when new money comes in, it usually chases some of the better quality stocks and then filters down to the lower ones. But as of right now, a very good week for the precious metals that just continues to tack on gains, and now a lot of juniors joining the party. Hey, Brien, that's what we've been waiting for a while. Let's truly hope that this does have at least a few more years in it, or who knows, maybe we have seen a generational shift here where commodities are simply more favored over the financial assets that have been favored in some of those tech stocks for decades now. We got to wrap it up here, though, Brien. Again, Brien Lundin, the editor of the Gold Newsletter and our host at the New Orleans Investment Conference, November 2nd to 5th. Click the link in our show notes to learn more about his upcoming conference. Brien, thank you as always for your time.
Thanks, guys. Y'all have a great weekend.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report, and now moving over to the energy sector, oil and natural gas, chatting with Josef Schachter, founder and editor of the Schachter Energy Report, writes the Eye on Energy report. That's his free report now on Substack, where you can follow along with more of the fundamentals around the oil and natural gas sectors. And that's where we're going to start here is with oil. We've been talking a lot about oil over this last month or so. And one thing I just keep looking at is that price breakdown on the oil chart below that $65 a barrel level. I find that to be a key level for oil to regain so it can get back into a trading range that it was in for a few years. Problem is, even with a lower US dollar right now, oil is still stuck below that level, about $62 a barrel. A lot of different negative factors playing into this lower price. OPEC raising production levels. We're also seeing storage being at pretty high levels. We're seeing weak Asian demand. There's a lot of things pushing this oil price down, but we do also have geopolitical factors that are, I guess, supporting somewhat of a oil price. It's a real mixed bag here. Personally, I still see a lot of negatives out there. So, Joseph, how are you balancing out the negatives and the positives for oil?
I think you covered it really well in terms of the different drags for higher and lower pricing. I think the key is going to be that summer driving season's coming very shortly after the July 4th long weekend for the U.S. We're going to see a lot more people spending time at home, tariffs and job issues. In Canada, the same thing. People will not be driving to the States. They'll be driving within Canada. So I think that the demand normally, once you get into the summer driving season, increases 1 million to 1.5 million globally, and that will be the trigger for moving prices back up. In the meantime, the issues that we're seeing with inventories, they were up this week by 13.4 million total stocks. The EIA released that on Thursday, and U.S. demand was down 714,000 barrels, and year to date it's only up 0.8. But motor gasoline demand is negative 0.2 versus a year ago. And the jobs number we saw from the ADP wasn't so good. We'll get the official job data from the U.S. on Friday. If it looks like there's weakening demand on the job side, part of it being all these people being sent out of the country that might have been working in low paid jobs, including agricultural jobs. So I think that we're going to be in a period of a little bit of a mess here. I'd be watching the bond market, the U.S. bond market, the 10-year and the 30-year bonds. If they break out to new highs in yield and the auctions don't go well, historically auctions are 2.5 to 3.5 times bid. So if they're doing 10 billion, you want to see 25 to 35 billion of bids. And if that number is 1.5 to 2, that's no good. And under 1.5, it's a problem. And usually when you get the bids that low, then the Fed arm twists the banks to pick up more and get the bid level up and make them take more of the paper of that auction. So if we see any bond vigilante issues in the coming months because of the debt, the deficit, they can't pass the increase in the debt limit, that could be the problem. The rise in interest rates also is a problem for banks. As you remember, Sovereign Bank got beat up, and many banks got forced mergers because the interest rates went up and they had a lot of treasuries on their books. Japan is the one that seems to be the one having difficulty because interest rates went from negligible to, I believe, in the 3% range, and many banks there, many insurance companies there have taken massive losses. And so that is an issue that could spread. And so that could be part of how we get the correction in the general market. And if we do see the market correct that 10-15% that I think it should, and we get the AI tech stocks at much lower levels, that would then give us the next buy signal for the general market. And energy probably getting back to the 56, 58 would probably bring stocks down 10-15%, and with many of them having very good yields, buying them 10% lower, 15% lower would be a great buying opportunity.
Well, Joseph, just to that point, so if we do see the general markets have a correction and that pulls down not just U.S. equities, but also a lot of the oil stocks, which are U.S. equities, along with them, you would see that as a area where you could accumulate because oil would be in the mid 50s. But you've maintained that you still see higher oil prices up in the 70s by the fourth quarter of this year. Walk us through, if people were to take advantage of that dip and buy the energy stocks in a mid 50s environment, what takes oil back to the 70s then by the end of the year?
Well, the first is you've got, bull and bear views of demand growth this year. The bears say maybe 800,000 barrels a day. The bulls 1.4 million. So that's the range for that. We know we're going to see, 411,000 barrels in May, June, July from OPEC. But I don't believe they really have the volumes. I think we're going to see that in the next few months. So when the OPEC report for May comes out, next time we talk, we can go over it and see what they did in May. And that should be released in the next week or two for May. And then we'll see June in mid-June. So each of these reports will be watched carefully to see if OPEC really has the volumes. From what I'm seeing, many of those countries are just getting more quota increase. They're already cheating, but they can't bring on more barrels. The only two countries that really have barrels that they can increase are Saudi Arabia and Kuwait. So we'll see, as we go along what happens there. But the real reason I'm bullish for the fourth quarter is Venezuela on May 27th was told they cannot export anymore. Chevron was told that they cannot bring 260,000 barrels a day into the United States Gulf Coast. So the big problem for Venezuela is they're selling a lot more to China and India. And if the sanctions are put on aggressively and banks and shipping companies and insurance companies on those ships tell the buyers you can't do that, that's going to knock off 500,000 barrels a day of demand from 1 million to 500,000. And then Iran, if they don't do a deal in the first Trump administration, when they put sanctions on Iran, they were able to knock the consumption down or sales down by 2 million barrels. So even if it's conservatively 1.5 million, between that and Venezuela, 2 million barrels not on the market in the fourth quarter, plus demand growth, I think that's going to be the reason for, $75 to $80 oil in Q4. And I think we peak through during 2026, during periods of cold weather or strong demand in the summer driving season, that we'll see $90 handle. So that to me is going to mean that oil stocks, that the ones you can buy in the next bargain window, potentially have upside over the next 12 months from E&P and service sector of 50% or more.
Just interesting to see OPEC, some of their comments saying that they're trying to regain market share, and they're trying to push out some of the higher cost U.S. shale operators, plus Saudi Arabia. Their price cuts to nearly 4-year lows. Seems like they're trying to take back some of this market share. I am curious what you think, though, of these rising inventories. The inventories in the U.S. are the highest since pretty much last year at this time, and that continued weak Asian demand. What do you see in these inventories in terms of history? How quickly can they be worked off when we are seeing them continue to build and we're continuing to see demand globally fairly weak?
Well, we're in the shoulder season now before the summer driving season. The two strongest demand seasons are winter and then the summer. So if the world demand this year is going to be averaging 105, we might have 106, 107 in the wintertime, 106 or so in the summer, but 102, 103 during the shoulder seasons. And that's when you rebuild inventories for those higher demand periods, which is the summer and the winter. And again, refineries have to convert to different grades of crude. In the summer, of course, they have to be more environmentally supportive for emissions for the summer grades. So that's why if you look at the utilization from the EIA today, 93.4% utilization, up 3.2, compared to a week ago, 90.2. A year ago, that was 95.4. So we're seeing the utilization of refineries converting to make summer grades, and that's why the inventory builds are occurring. And if we see the driving season starting week 1, week 2 of July, start to draw those inventories down, then the bullish thesis is intact.
Well, Joseph, let's also shift over to nat gas and work that into the discussion. When you look at U.S. pricing, it's around 370 at the time of this call, still hanging out there in the middle of the range it's been in. But I know that AECO pricing is a lot lower. I wonder, can the Canada's pricing in the nat gas market close the gap a little bit on the U.S. price? And then we hear a lot about LNG terminals. We hear a lot about electricity and the demand for nat gas power. What's your outlook on nat gas in general over the next, let's say, 6 months to the end of the year?
Well, let's go into the U.S. first. There's a number of new projects, new LNG trains coming on before the end of the year. So those new trains plus winter will probably push the price of NYMEX into the 4.5 range from the 370 that you mentioned that it's trading at today. For AECO, it's pretty horrible at $1.95 an MCF, but starting next month, we start moving LNG through the trains at LNG Canada, and they start exporting them. And so 1 BCF, I think, is where they're going to start per day. And then by the end of the year, it might be 2 BCF a day. And then hopefully more projects will get approved, given the friendliness between the provinces and the federal government on pipelines for natural gas and LNG, et cetera. So I think that sometime in Q4, we should be looking at AECO trading in the $3 range, and in 2024 maybe 354, depending upon how cold the winter is and how strong the demand is for Asia. And so if the Chinese are not buying from the United States because they're still having the tariff war, they may be a buyer for Canada, and that might push the price up quite a bit. And then as other projects move forward, we'll see that, them trying to capture TCFs of reserves, and that could lift the price as well, plus potentially M&A deals to buy up more natural gas companies is part of what I think will happen in 2026.
Joseph, I'm curious what you have to say about seasonality. Natural gas is subject to seasonality. Time and time again, we know when high demand kicks in, we know when demand tapers off. And yes, it depends a whole lot on weather, but with more LNG terminals and with the longer term bullish outlook for demand coming from AI data centers, do we see less seasonality in this market?
The LNG market, because Europe is trying to refill their stocks for next winter, and also the same thing with Asia, you see less shallowness in the soft periods of spring and fall. But it is, the demand domestically that matters a lot because it's a bigger component of the usage versus the export market. For example, the exports on oil today, 3.91 million barrels of light oil were exported, but that was down 394 from a week ago. And the U.S. was producing 19.5 million barrels. So, they were importing probably 3.8 of Canadian because they need the heavy oil. I'm interested to see if that pops over 4 million as we see Chevron losing the ability to bring in heavy crude into the Gulf Coast. And I'll be watching to see the Canadian numbers pick up. If they do, Enbridge still has a little room. We know that there's probably 200,000 barrels more available on TMX, but that TMX could be full within a year. You saw the Strathcona deal on Hardisty, where they're going to take over the facility to load tankers so that tankers can be taking heavy crude to wherever the demand is. So they're making a bet that there won't be an Eastern pipeline. Even if TMX does expand it a little bit and Enbridge expands it a little bit, we're going to see the growth in the heavy oil in Canada need to go by rail again.
Well, Joseph, I appreciate you laying down the framework for the oil and the nat gas macro side of things, but let's shift over into some of the companies now. And I want to pose a question for you. Would you be more animated by stocks that are more totally oil focused, totally nat gas focused, or that have a hybrid play where they've got a nice mix of oil, nat gas liquids, and nat gas? Which one would you think has the edge over the next quarter?
Over the next quarter, I don't want to predict, but between now and year end, I think the oil price recovery is going to mean that oil stocks will do much better. And, you go to something like a white cap, trading today at 860, it's got an 8.6% dividend yield. You look at a Vermilion, which is about half and half, You got a 5.5% dividend yield. You look at Enbridge, a pipeline yielding 6%, Freehold royalties, a 9-cent monthly dividend, 8.8%. So you've got some very, very attractive yields. Marin Energy, the old Africa Oil, 10.8%, and Surge Energy, which is, 24,000 BOEs a day, paying a monthly dividend, 9.9%. So there's a lot of exciting things out there. And I also like the natural gas focused companies because the leverage to those companies is very significant. So a Pine Cliff will do much better. You'll see, Kowitno do much better, Bonterra do much better. And, everybody is going to want to own the stars, which are, the Tourmalines, Paramounts of the world. So to me, there's a lot of opportunity. You do want to even have some of the service sector because right now the stocks are trading close to 52-week lows. And you're looking at companies that will benefit because as the utilization rates go up, as we start drilling more to meet the LNG export demand, that's going to cause rates to go up for both the drillers, the service industry, and the frackers. So we think people should have exposure to those companies as well. And for example, in our case, we own Trican.
What about dividend paying stocks? A lot of people do move into the energy sector for income type stocks. If oil hangs out, if it doesn't recover quite as quickly as you think, if nat gas stays at this level, how attractive are the dividend paying stocks? How solid are dividends?
Well, if you're looking at $50 oil, I think you're going to have to be doing a lot of due diligence on balance sheets and cash flow and debt payments and all that. And you might find some companies may not be able to pay the dividends. If we peak down for a very short period of time to 56 to 58, and then we get into the summer driving season, which is a month or two away, demand picks up, prices pick up, and then we go into Q4 and Iran and Venezuela are out of the market, that's when I think the bullish story takes the winning position, and I think you'll see much higher prices then. So the industry can't make money at $62, $63 oil. It's just trading, dollar for dollar, and companies want to make a profit. So they're only going after their tier one inventory because they can make 1 year returns on them. But tier two and tier three are not economic. So you're going to start seeing more weakness in U.S. production over time. And I think the Canadian numbers will be flat. Companies will be reporting flat quarter over quarter numbers. And the focus for the debt companies is that they're going to want to knock down debt. And if they're paying an NCIB, they may not spend much money on the NCIB when prices are low. And when prices pick up back into 70s, they'll reactivate their NCIBs.
Well, Joseph, let's dig into that last point you made even further. So with the NCIBs and the share buybacks, yeah, if the revenues are depressed a little bit because pricing is depressed, would you rather see companies dial that back? Obviously, if they change the dividend, that's more of a negative signal. Would you rather see them scale back growth? Would you rather see them extend their debt repayments? In a environment, if the pricing does stay lower for longer, how would you like to see companies maneuver in that environment with all those different options they have?
Okay, if I'm wrong and the price of oil goes down low 50s, breaks 50, survival is important. And the big thing is companies that have debt, the banks or their lenders breathe down their necks and say cut spending, sell assets. So survival becomes the issue. They're not doing NCIBs, they're not doing growing production. They're going to have to cut back their dividends as we've seen in other periods of time. I just don't buy that case right now. I think that, if we went down into 40s, it would, let's say, the Straits of Hormuz gets, or something happens, geopolitically, that everybody gets worried about massive slowdown in economic growth and the price of oil goes into the 40s. But I don't think it lasts for very long because I think that, we're going to see Venezuela and Iran off the market by the end of the year, and that will be the bullish reason for higher prices.
Let's talk smaller market cap stocks then, either in oil or nat gas. They have broadly lagged some of the much larger stocks. Some have done well if they've done some strategic acquisitions and been more on that growth trajectory. However, most small market cap stocks in the energy sector are on a growth trajectory. It's just all about ramping it up. How do you see them playing into the mix? What's your forecast?
Well, there's a lot of companies out there that are growing modestly. Some have no debt, like Hemisphere. They pay a 10-cent regular dividend, 2.5 cents a quarter, and then they pay specials three cents, and I think they paid two last year, one already this year. So you're looking potentially 16 cents on a $1.73 stock, growing production, and they're looking for more projects to grow. You take Petrus Resources, which is a Cardium producer, 9,000 BOEs a day, 12 cents, so a penny a month, 9% dividend yield. And then, you got a number of others where there's, 9, 10% yields where their balance sheets are getting better and better all the time. And, they would hold growth off to keep the dividend because their shareholders want it. Some of them have NCIB, some do not. And some companies believe only in NCIBs and not in dividends. So because they want to, their NAVs are so much higher, and what they're trying to do is buy back stock, and the remaining stock is more valuable because of the shrinkage of the share count, and the reserve base is divided by less shares.
Joseph, let's also talk M&A in the sector. In the environment where oil was in the 70s, 80s, and 90s versus now where it's in the 60s and possibly a little dip into the 50s, does it change the dynamics between buyers and sellers? Are companies more willing to strike a deal in this kind of an environment, in your opinion?
I've been asking companies that, and most of them are saying to me the spread between buy and ask is too large. People don't believe this $62 price of oil. If price of oil was 75, you might see bid asks, narrow. So it's an interesting dynamic here. But you're still seeing deals done. You saw Varen with Whitecap. You're seeing CNQ with the Chevron deal. You just saw Strathcona selling their natural gas assets to ARC and to Tourmaline, and then they're now going after a MEG. So there is deal flow going on, and it's more of a strategic deal flow, but I think it's going well.
So, Joseph, kind of on a tangent here, there any new or emerging areas that have your interest, or any new technologies that are in this market that you see as game changers, either for investors or for the sector?
The companies have changed their fracking techniques. They've changed the length of their wells and the productivity of those wells. That's why you're seeing mergers, because you want more land, and then you can drill longer reach wells in the Duvernay and the Montney and in the Permian and the Eagle Ford. So a lot of that stuff is really doing, the technology side, and the industry spends a lot of money on mission controls. They want the frackers to be using natural gas on site. They want to see, more electricity for all of the, other equipment that's on the drilling site. And if they do that, they can argue that we are the most climate friendly drilling and producing country in the world.
When it comes to oil services, there's a range of different companies you can pick from. Some of them have this technology or some of this new processes you're talking about. Of course, there's pipeline companies, there's drillers, there's other oil services branches. Is there any other companies that stand out where you think they have an edge right now just because of the niche that they're in?
Well, if you look at CES Energy Services, they are the people who provide fluids for the wells, and with the wells being more complicated and longer, they have higher margin products that they're doing well. And if you look at their, second quarter, they had a very decent quarter. And I'm going to be meeting with that management next week to go over in a little more detail. But I think that stock is quite cheap, and we put it as a top pick last month. And then you look at, Total Energy. They've done very well in Canada. They're doing very well in Australia, not so well in the States. But, the same thing with Precision and Ensign. They're very big in the States, so they're not doing so well. In the case of Total, they're doing well because they have a very big compression business as well as a very successful Australian business. So it's one of the names that we really like. And CESI is the other one on the service sector. And we're looking for more names all the time. As I mentioned, Trican is a favorite. So we're looking at the different names and just seeing, at the price that they're at, are they very attractive? And if they are, then they would go on our top picks section in our SCR. So, for people who'd like to find out about our product and our names that we cover, go to SchachterEnergyReport.ca. We have two price points, the annual and the quarterly. So if you want to just get your fingers wet and feel out if it's a good product for you, take 1 quarter. And if you like the product, then go annually, which is cheaper. And then when we start to Ion Energy in September as a paid product on Substack, if you want that macro view, which has been very good and we've been very good on, then that's something you might want to take advantage of starting in September.
All right. I'll post a link to that. We get both of Josef's reports, and they really do a great job bringing you up to speed on what's happening, fundamental side of the oil and natural gas market, and then diving down into the companies through the Schachter Energy Report. That's where Josef does a lot of work, and that's where you can find out a lot more about the companies in the space. Josef, great chatting with you, everyone. Thanks for tuning into this weekend show. Please go back through, especially if you listen on a podcast player, subscribe, like, and review our podcast. Feel free to leave any comments as well. And feel free to share our podcast with any of your associates, coworkers, and family, anyone who you think would enjoy it. As always, you can keep in touch with Shad and I through email, and be sure to listen to all our daily editorials and company updates that we recorded throughout the last week. It sure is busy right now in the resource sector, especially metals and mining, precious metals. Josef, again, thank you for your time, everyone. Thanks for tuning in to this weekend show. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.